What's up, guys? Today we're covering a money hack for trading stocks. I'm investing $10,000 in 6 different stocks at about the same time, and we're going to find out which one makes $1,000 the fastest. But here's the deal. I'm not just picking random stocks, we've got a system. I'm looking for stocks with high relative strength that are near long-term moving averages in sectors that are lagging, but with amazing sales and earnings growth. I know what you're thinking. Evan, what does any of that mean? Don't worry, I'll explain everything as we go. And check this out. 3 of these stocks are going to make money pretty fast, while the other 3, not so much. By the end of this video, you'll know exactly which stocks can help you grow your money the fastest. And to make things interesting, I'm giving an official bull and bear brief hat to one person who comments which stock they think will win before I reveal it. Comment below with your guesses. Now we're going to see which of these investments wins over the next 2 weeks by hitting $1,000 in profits first. Before I reveal our stocks, let me quickly explain what I'm looking for and why it matters. When researching the best way to find winning stocks, I learned that there are 5 factors that can help spot potential winners. First, we want high relative strength. This means that the stock is already going up faster than the overall market. Basically, we want stocks that are already winning. See how this stock is climbing faster than the market? That's what we want. Winners tend to keep winning. Next, we want stocks near their 21-day, 50-day, or 200-day moving averages. These are common areas investors watch where stocks often find support and bounce higher. It's like a trampoline for stock prices. When a strong stock touches these lines, it often bounces back up. We also want stocks in sectors that have been lagging the market for a couple months. Common growth sectors can include software, computer chips, and popular consumer brands. Why look for lagging sectors? Because strong stocks in weak sectors are like superstars. When the sector eventually catches up, these stocks can rocket higher. Now for the business fundamentals. We want companies growing their sales by at least 5% year over year, because a company can't grow if it's not selling more stuff. And most importantly, we want earnings growth over 15%. That means the company is making way more money than before, and in the end, that's what drives the stock prices higher. So now you know my formula for finding potential winning stocks. Let's see which companies match our criteria. These are my 3 growth candidates. Let's break down each one. First up, Okta. These guys are cybersecurity specialists focused on identity and access management. Basically, they make sure the right people can access your company systems and the wrong people stay out. With all the data breaches and hacks these days, Okta's services are in huge demand. They protect over 18,000 organizations worldwide. They have sales growth of 10%, beating our 5% minimum. Earnings growth of 76%, crushing our 15% minimum. Relative strength in the top 9% of the market. Currently trading near its 50-day moving average in the cybersecurity sector that underperformed the market in the last 3 months. They're growing fast with 10% sales growth and 76% earnings growth for 2025. And check this out. They have over 18,000 business customers relying on their platform every day. Next up, CrowdStrike, another cybersecurity company, but these guys focus on stopping breaches with their cloud-native Falcon platform. CrowdStrike uses AI to detect and stop threats before they can do damage. They're basically the bodyguards of the digital world. Sales growth, 20%, 4 times our minimum. Earnings growth, 27%, almost 2 times our minimum. Relative strength, top 10% of market, trading just above its 21-day moving average. In cybersecurity sector that underperformed the market in the last 3 months. CrowdStrike is absolutely crushing it with 20% sales growth and 27% earnings growth. Their AI-driven security platform protects companies from cyber attacks, which is a massive and growing market. And finally, Twilio. These guys provide the technology that powers communication between apps and users. Ever get a text from DoorDash about your delivery, or a verification code when logging into your bank? That's probably Twilio working behind the scenes. Sales growth, 8%, more than our minimum. Earnings growth, 24%, almost 2 times our minimum. Relative strength, top 9% of market, trading near its 200-day moving average in a software sector that underperformed the market in the last 3 months. Twilio connects businesses with customers through text, voice, email, WhatsApp, basically any way people communicate digitally. They're growing sales at 8% and earnings at 24%. All 3 of these companies are growing fast, have strong relative strength, and are in sectors that have been lagging the market. That's my perfect formula. Now let's look at my other 3 stocks. These are popular dividend stocks that a lot of people buy for income, but they don't match our growth criteria. First is Kraft Heinz, ticker KHC. You definitely know their products. Kraft Heinz makes some of America's favorite food brands, but here's the problem. Sales growth, minus 2%, below our 5% minimum and negative. Earnings growth, minus 15%, way below our 15% minimum and negative. Relative strength, bottom 39% of market. Kraft Heinz is trading near but below their 50-day moving average. Their sales are actually shrinking by 2%, and earnings are shrinking at 15%. They do pay a nice 5.8% dividend, but remember, I'm looking for growth to make me $1,000 fast. Next is Molson Coors, ticker TAP. They make all kinds of beers. Molson Coors owns brands like Coors Light, Miller Lite, Blue Moon, and more. But look at their numbers. Sales growth 2%, below our 5% minimum. Earnings growth 1%, below our 15% minimum. Relative strength bottoms 62% of the market. Dividend yield 3.3%, trading just below its 21-day and 50-day moving averages. Sales growth of just 2% and earnings growth of only 1%. They pay a 3.3% dividend, but that's not going to help me reach $1,000 in profits quickly. Finally, we have Coca-Cola Company, ticker KO. Don't confuse this with Coca-Cola Consolidated, ticker Coke. That is actually the largest Coca-Cola bottler in the United States. They own brands like Coca-Cola, Powerade, and various other products all over the world to billions of consumers. Let's check their numbers. Sales growth 3%, below our 5% minimum. Earnings growth 3%, below our 15% minimum. Relative strength bottoms 69% of market. Dividend yield 2.9%, trading below all major moving averages. Only 3% sales growth and 3% earnings growth, and they only pay a 2.9% dividend. So these three companies, KHC, TAP, and KO, are what many people consider stable dividend stocks. They're established companies with well-known products, but they're not growing fast enough to meet my criteria. Alright, now let's get to it. I'm going to invest an equal $10,000 in each of these 6 stocks and track them for 14 days to see which one makes me $1,000 in profits first. Let's reveal my final leaderboard. CrowdStrike, ticker CRWD, made $2,029, a 20.29% gain. Okta, ticker OKTA, made $1,906 with a 19.06% gain. Twilio, ticker TWLO, made $1,621, a 16.21% gain. Coca-Cola Company, ticker KO, lost $295 for a negative 2.95% loss. Molson Coors, ticker TAP, lost $356 with a 3.56% loss. Kraft Heinz, ticker KHC, lost $596 with a 5.96% loss. CrowdStrike is our winner. They hit the $1,000 profit mark in just 2 days. And look, all 3 of my growth stocks outperformed the dividend stocks by a huge margin. During our tracking period, the stock market rebounded from a pullback, and these strong growth stocks that were in a lagging sector roared back to life and quickly went higher. But the most important thing is that CrowdStrike matched all of my criteria: high relative strength, trading near its major moving averages, in a lagging sector with amazing sales and earnings growth. Meanwhile, my dividend stocks didn't even go the right direction. Coca-Cola, Molson Coors, and Kraft Heinz actually lost money. This perfectly illustrates why growth stocks, when bought correctly, can help you reach your financial goals faster than slow-moving dividend stocks. So what did we learn today? Growth stocks with strong fundamentals can help your money grow much faster than traditional dividend stocks. My winning formula works. Look for stocks with high relative strength near long-term moving averages like the 21-day, 50-day, or 200-day in sectors lagging the market with sales growth over 5% and earnings growth over 15%. In just 14 days, CrowdStrike made me $2,029 on a $10,000 investment. That's more than a 20% return in less than a month. If you could keep up even 10% of that pace for a year, that would be an incredible year. Stay tuned for 30 more seconds to learn how you can find more stocks like these to supercharge your portfolio. Of course, we have to note that investing always comes with risks, and past performance is not a guarantee of future results. Never invest money you can't afford to lose, and always do your own research. If you want to find amazing growth stocks like these without doing all the in-depth research yourself, I've got something special for you. I run a stock picking newsletter called the Bull and Bear Brief, where I send subscribers one carefully selected stock pick every week that matches exactly the criteria we covered today. Relative strength, key moving averages, strong fundamentals. I do all the hard work for you. And the best part, it costs less than $1.30 per day. That's right, for just $39 per month, you get 4 premium stock picks that could potentially deliver returns like the ones you just saw, just usually over a bit more time. Head over to bullandbearbrief.com to sign up now. Don't miss next week's pick. It could be the next stock that helps you build long-term wealth. If you enjoyed this video, smash that like button. Subscribe for more growth stock and finance content, and let me know in the comments what videos you want to see next. Thanks for watching. See you in the next one.